Global equities had a particularly strong start to the year, driven by better than expected economic and consumer data out of the US, Europe and the UK. What is interesting is that the improvements in the composite PMI in the US and Europe have generally been driven by a normalization in energy prices, lower than expected or better than expected inflation data, and reopening of China after an extended period of lockdown. While monetary policy globally remains fairly tight and we've seen disruptions in financial conditions such as the collapse of Silicon Bank, MSCI World Index was up 12.5% and the Emerging Market Index was up 7.6% during the quarter. Commodity markets were fairly weak as energy prices normalized. Metal prices were lower with the exception of gold, copper and iron ore. And the local market, despite a strong January, which saw strong returns coming through, only generated 2.4% during the quarter as the impacts of load shedding, policy uncertainty and other aspects impacted returns. The financial index was fairly flat, slightly down 0.3%. Resources were down about 4.7%, and the industrial index generated most of the return, increasing by approximately 14%. And this was mainly driven by strong performances from Richmond, Naspers, and a number of the Rand hedges, which had a good quarter. The North Star Equity Fund had a relatively strong quarter, generating 4%, handsomely beating the market, which was up 2.4%, as well as beating peer average, which was up 2.6%. What is pleasing is that the source of return was both from an allocation and selection perspective. The fund was broadly underweight materials and overweight industrials, which benefited the attribution numbers. And from a stock selection perspective, we saw good results out of a number of conviction calls such as Bedvest, Bedcorp, Supergroup, and a number of others, which had a strong quarter. From a positioning perspective, the fund, our fundamental work suggested rotating a number of positions, and in particular a number of the positions that did particularly well, including Naspers, Richmond, and a number of global counters which had performed exceedingly well. And those we rotated in banks, a number of industrials, and in select financial counters. Overall, we remain underweight materials and underweight cyclical Rand hedges, with as we think that these counters are pricing in overly optimistic global growth conditions. And we think that the South African trade, mainly banks, retailers and the industrial space, is too cheap to ignore. And we've maintained an overweight position in those.